can smell that desperation, you are probably not going to get fair market value. In extreme circumstances, you can file for bankruptcy. After you've filed for bankruptcy, you go into a period of protection that you can use to restructure debt and hopefully emerge healthier. Now, are there any numbers here we can do? There are a couple of examples in the curriculum, so I've just pulled one out here. It's not a particularly earth-shattering calculation, but the point is if you start to sell off assets to try and meet your liquidity requirements, you're not going to get full value. We have here a company with short-term marketable securities with a fair value of 10, inventories and receivables with a fair value of 20, real estate 50, and a subsidiary worth 30, 110 in total. Now, using those assets to meet your liabilities as sources of liquidity, short-term marketable securities, by their definition, if they are marketable, you can quickly sell those without loss of value. So you wouldn't expect any cost there. And you get the full 10. Hooray. Really, a primary source of liquidity. Inventory and receivables of 20. If you're having to sell those off to meet a liquidity crisis, you're not going to get full value. The liquidation cost here is 10%. You lose 2, get 18. Not tragic. Just 2%. Sorry, just 10%, just 2 million. Real estate, this is where the costs start to rack up. You're getting into your secondary sources of liquidity. You are not getting full value. 15% cost, 7.5 million cost of selling off that block of real estate. You only get 42.5. And selling off a subsidiary in a fire sale, because you're in a crisis, 20% discount you have to give. You're losing 6 million of value. 110 was the fair value. Total costs here add up to 15.5. Your net proceeds only 94.5. So dipping into secondary sources of liquidity is going to cost. Now, we've defined liquidity. Earlier on, we talked about the cash conversion cycle. The two are linked. The cash conversion cycle has a significant impact on liquidity. Think of the assets we're looking at when we talk liquidity. Inventory, accounts receivable, accounts payable. They are all, 3 of them, key parts of your cash conversion cycle. And we can start to define the impact on liquidity of changing your accounts payable, accounts receivable, and inventory. And the 2 definitions we have here for impacts on liquidity are drags on liquidity and pulls on liquidity. Anything that delays a cash inflow, so causes a lag of your cash inflow, is a drag on liquidity. Anything that accelerates your outflows is a pull on liquidity. It's pulling cash away from you, whereas a drag is delaying cash coming in. Classic drags, uncollected receivables, that clearly delays cash coming in. Obsolete inventory. Obsolete inventory is sitting in your warehouse too long. It's taking too long to turn into cash, if it will at all. And borrowing constraints. If you're in trouble and you can't borrow, you can't get cash in. That's a drag on liquidity. Pulls means paying out. Early payments. If you pay off your suppliers quicker, early payments, that's the pull on liquidity. Reduced credit limits means you don't have the luxury of sitting there and waiting to pay. Limits on short-term lines of credit, same thing. And low liquidity positions. They are all pulls on liquidity. As an example, imagine you see a firm here with these 3 trends. Number 1, an increase in average days of sales outstanding, DSO. We saw this in the cash conversion cycle. What is days of sales outstanding? It's a measure of how long it takes your customers to pay you. If that's increasing, they are taking longer to pay you. That's delaying your inflow. That's a drag on liquidity. An increase in days of inventory on hand could be from obsolete inventory. That's our DOH. That's a drag on liquidity. Number 3, an increase in credit limits offered by suppliers. linked to DPO here, this is actually, so be careful with the wording, an increase in credit terms. That's actually good news. That is neither a drag nor a pull on liquidity. Reduced credit limits would be a pull, but not an increase. We've defined liquidity. We've looked at drags and pulls. Next up, measuring it using ratios. Once more, and make no apologies for saying this over and over again, you are going to see much more of this in FSA. In fact, you will see this exact page in the FSA module. Liquidity, we know, is about your ability to meet short-term obligations. Levels of liquidity required differ by industry, so just like the cash conversion cycle, it's impacted by your industry. So is your liquidity level. Banking, for example, you're not going to have inventory to meet it, but you do have requirements to meet depositors' needs. You have to be standing ready to repay deposits. Is it adequate? Well, it depends on the analysis of historical funding needs, your access to capital. We may have very low liquidity, but if we have a lot of sources available, we're okay. We measure it via 3 ratios. First one, the easiest, current assets to current liabilities. If you're using the current ratio, you are inherently assuming your inventory and your receivables are liquid. We can turn them into cash quickly to meet our short-term liabilities. But is that true? If you're a builder and you have a bag of sand ready to make cement, to go into building a house, to sell, to collect cash on, it's not that liquid. So a tighter measure of liquidity is your quick ratio. That's just cash and short-term marketable securities or investments and receivables. What you're removing is inventory. Compare that to current liabilities. If you want to go tighter still, a real crisis measure, let's compare just cash and short-term marketable investments to current liabilities. The higher these ratios are, the more liquid you are. The lower, the more your reliance on generating cash elsewhere, CFO or other sources of finance. Let's see an example. Consider the following balance sheet. So we have at the top our total assets, at the bottom our total liabilities and equity. Let's calculate. So which way is time going here? Time is going from right to left, 01 to 02. Let's calculate our, first of all, net working capital. Remember, net working capital, we are trying to focus on just those assets and liabilities that are linked into the operating cycle. So if we do it for 20x1, first of all, I'm not going to include cash in my net working capital, nor marketable securities. What I will include are accounts receivable, inventory, prepaid accounts. They're the current assets I'll put into net working capital. Net property, plant and equipment, that's long-term, as are intangibles. So for 20x1, I think for net working capital, we've got 90, 66, and 15. That's 171. Liabilities, accounts payable, and accrued expenses. I'm not going to include my short-term loan, even though it's current, because it's not tied into that operating cycle. And long-term debt and equity, obviously not. So these are my current liabilities. I'll have 155. 171 minus 155, 16 is our net working capital. Similarly, you can calculate that for 2002 as 65. And the point of this reading, or this example, I should say, is look, net working capital has gone from 16 up to 65. Yay. You would look at that and say liquidity is increasing. Things are going well. And you can back that up with the current ratio. The current ratio we know is all current assets. So to get the current ratio, you would actually take cash and marketable securities as well. All current liabilities, you would include that short-term bank loan. And if you do that for both years, you see the current ratio has gone up 136 to 152, again suggesting liquidity is improving. However, what's driving it? If you calculate the quick ratio, you see liquidity looks like it's actually decreased. What is the difference between the current ratio and the quick ratio? Inventory. If you take out inventory from the current ratio and calculate instead the quick, you get a different story about liquidity. And you can see it here. The biggest move in current assets by far is that a doubling of your inventory. Accounts receivable haven't really done that much. Marketable cash, all minimal movements, prepayments. Accounts payable, not that much. Accruals, not that much. Short-term debt, not that much. The big movement there is inventory. You go to the cash ratio, again, you can see it's fallen from 0.6 down to 0.5. This may be a concern. As always with ratio analysis, the ratio itself does not give you an answer, it just begs a question. Is this increase in inventory, this build-up in inventory, in anticipation of higher demand? Has it resulted in more sales? Or is this obsolete inventory that we are unable to shift? Depending on the answer, this could be a concern. Okay, to finish off on that little liquidity chat, I've just put an example in here for those of you who have already looked at financial statement analysis and are now frantically Googling what free cash flow should be. Let's just make sure we know what they're calculating here. We have the information for Lucor Corporation. Well, net income isn't cash. Cash flow from operations is cash. So we have CFO of 1400. That's where we'll start. But CFO is not all free to be spent. Some of it needs investing in long-term assets. What do we have? Investment in long-term assets. 800. There's my investment in long-term assets. Deduct that from our CFO. We are left with 600, which is the answer we come up with. Now, the reason I point that out and say you might be kind of panicking a little bit when we get to FSA and we calculate free cash flow to equity, we would also take into account funds we've raised from debt issue. They don't do it here in this module. As I say, don't panic. If this comes up, they will be clear on the definition they want you to use. Final LOS then. Describe issuers' objectives and compare methods for managing working capital and liquidity. Makes sense to start with the objective first. And think of this as a balancing act. What we really want to do is maximize our firm value. That's our aim. Remember from the corporate governance modules in corporate issuers, the role of the board, the aim of the board, the reason the principals hired those agents is to maximize shareholder value. That's what we're trying to do. How do you do that? As we've talked about in this module, you shorten the cash conversion cycle. Go around that cycle quicker, minimize your working capital, and you will minimize the costs associated with financing that working capital. There is a limit to how far you can shorten it. Depends on your business model, as we said. But get it short, minimize the financing cost. If you can, turn it negative. Ideally, get your suppliers to finance you. Do what Starbucks do and get your customers to finance your working capital. Come up with some crazy scheme whereby customers are willing to pay you before they buy the product. Sounds mad, but if you have a Starbucks card and you load it up, that's exactly what you're doing. Yes, I will willingly pay $25 for coffee I'm going to buy in a month's time. Madness. But you have to balance that with having accessible funds available. Minimizing your working capital leaves you open to risk of stockouts, risk of not being able to meet your liabilities as they fall due. So you need accessible funds. You want to maintain ready access to funds necessary for your day-to-day operations. Yes, minimize the excess, but you have to have enough available. How do you do that? Well, number one, determine what your optimal working capital level is in relation to your revenue. Secondly, forecast your future working capital levels based on your revenue forecasts. So we're seeing the word forecast come up an awful lot here. Being effective in terms of your working capital management is therefore going to depend on how accurately you can forecast. There are two elements of working capital to forecast: a permanent level So what you need on a relatively permanent level, a constant level of inventory receivables you'd always want to have there, and a variable level, seasonal requirements. Obviously, retailers, their business is highly seasonal. There will be periods of the year where you need to up your staffing requirements, up your inventory levels to meet demand. So we'll forecast both permanent and variable current assets. And once we've done that, we'll decide on an approach to working capital management. And we've got 3 approaches here: conservative, moderate, and aggressive. They differ, first of all, in your level of short-term assets. How much working capital are we going to keep? And I think the names of these approaches kind of tell you what's going to go on. If we're being conservative, we're going to have a lot of assets just to be safe. Aggressive, or cut it down to the bare minimum. And secondly, they differ in the maturity of the finance used. Are we going to finance using short-term or longer-term debt, or equity for that matter? So let's have a look at them, starting on the left with the conservative approach. Lower risk, a safer approach. You have large short-term asset positions versus your sales, and you finance it with longer-term debt and equity. Compare that to the far right, aggressive approach, where you have a much smaller short-term asset position versus your sales and you finance it short-term. Moderate is in the middle. The interesting thing about moderate, it's sometimes referred to as matched because we're going to have, a moderate short-term asset position versus sales, okay, but we're going to match the funding. Our permanent level of current assets will be funded with long-term debt. That matches because they are there long-term, they're permanent. Our variable, so our seasonal requirements, will be matched with short-term debt. They're only there short-term, let's finance them short-term. So I've made up some numbers. A conservative approach, you might have a permanent level of current assets of 100, variable of 50. Financing it conservatively. So you're financing more than your permanent current asset base with long-term debt. All of your permanent is financed with long-term plus a little bit of your current. And then a little bit of short-term debt, just 20. At the other end of the scale, being very aggressive, you have a much lower level of current assets, only 80 here as opposed to 150. And very little use of long-term debt. Although we have 60 of permanent current assets, only 50 of that is being financed with long-term debt, some of it short-term, and all of your current assets with short-term debt. And in the middle, moderate, so a moderate level of assets between the two. But as I say, the interesting thing, it is perfectly matched. Your permanent financed with long-term, your current financed with short-term. What are the advantages and disadvantages of each? Well, if you take a conservative approach, remember you have the largest amount of current assets and the most long-term finance. Ultimately, that means you have greater certainty, lower risk, but it comes at a higher cost. More assets and potentially more costly finance. When are you going to use a conservative approach? It's typical for firms in early growth phases, mainly because their access to short-term debt is limited, or more established companies who might be able to say, look, we can stomach this higher financing cost because we can pass it on. We have the pricing power. And it's suitable if the expectation is for flat to rising interest rates. Why? Well, that's driven by this part, long-term finance. If you think rates are going to rise, I don't want to be rolling over my debt all the time, having short-term debt that I have to keep re-upping, because if rates are rising, I'm going to have to do that at a rising rate. No. If I expect rates to rise, let's tie in a long-term rate now. Advantages of this conservative approach: greater flexibility, because you've got more current assets, but at a higher cost, as we said. Certainty of working capital needed to purchase the necessary inventory. You know you've got the assets available. There's very little risk. It reduces your need to access capital markets during times of market stress. So COVID comes along again, another crisis, an 08 crisis comes along again. You have the assets already available. You don't have to turn to the markets. Financing costs are known up front because we have these longer payment terms. We have this long-term finance. Stable, permanent financing. It avoids rollover risk. What's rollover risk? If you have short-term debt, you have to keep rolling it over. You might have, for example, debt that matures in 7 days. Every Monday, you just have to re-up it. If there is market stress, if there is a crisis, all of a sudden people don't want to roll over, you're left without finance. Exactly what happened during the great financial crisis back in 08. So downsides. Long-term debt usually involves higher interest rates. We are assuming there an upward sloping term structure of rates. Might not always be the case, but that is our typical position. High cost of equity if the long-term finance you're using is equity. Permanent financing means not borrowing only as needed. If you have short-term borrowing, you can be very specific about the exact amount you want. Here, you're probably going to have excess borrowing that's sat there on your balance sheet costing you money. You need longer lead times to establish your financing position because you've got longer term finance. You need to look further into the future. It takes longer to set up. And if you have long-term debt, those providers typically place restrictions on your operations. They're not getting their cash back for a much longer time. That exposes them to more risk. They want to put in some restrictions, some covenants to make sure You don't do anything crazy before you pay them back. What about being aggressive, the other end of the scale? Smallest level of current assets and more short-term finance. Not as flexible. You're living right on the edge, but you'll get higher returns because you've minimized your costs. When does it happen? It might be necessary because you have lower profit margins. You just can't afford to have that high level of current assets. More suitable when future sales and cash needs can be forecasted with a high degree of precision. We said this was going to be dependent on forecasting permanent and variable current assets. If you're going to live on the edge, you need to have a very clear idea of exactly what your needs are going to be. Suitable if your expectation this time is for stable or falling interest rates. If I think rates are falling, I want short-term debt because every time I renew, it's going to be, if I'm right about my prediction, at a lower interest rate. Might be adopted for firms that expect to shorten their cash conversion cycle so their liquidity is going to improve. And they have liquid inventory and accounts receivable that they expect to be able to collect quickly. Pros, lower cost. Simple as that. You have the flexibility to borrow only as needed, again, bringing costs down, reducing your total interest expense. You don't have long-term debt sat there doing nothing. Short-term debt typically doesn't have these restrictions on operations that we talked about with long-term debt. You have the flexibility to refinance if rates are falling. If you are right about that, it's good news. But the downside, you have variable interest costs. It's not predictable like it was with long-term debt. We have a 15-year bond. We know exactly what we're paying on that 15-year bond. If I'm having to renew my debt every 7 days, roll it over at a different rate, it's more difficult to predict. Higher short-term cash needs to service the debt. You have longer debt, you're not paying it out for a long time. But if you're rolling it over every 7 days, you have to have the cash available to pay it back. Maybe people don't want to roll over. Rollover risk increases bankruptcy risk. If all of a sudden, nope, we're not re-upping, you're gone. Think Bear Stearns, Google Bear Stearns back in the crisis. Exactly what happened rather to them. They were rolling over the debt they needed for their short-term operations, their day-to-day operations every week. All of a sudden, when the crisis started to manifest, rumors went around they couldn't repay. All of a sudden, nobody wanted to roll over. They had to repay every piece of short-term debt they had, and quite simply, they couldn't. And there's more reliance on trade credit and collecting your accounts receivable. So it becomes absolutely key to be super efficient with your cash conversion cycle. To help, you might sell off some of your accounts receivable, use a third party. There'll be a cost to that, but at least it gets your cash in quickly. And sat in the middle, moderate. Not written everything out again here because I think it's fairly obvious. You have permanent capital with long-term finance, variable with short-term. You may adopt it when you are gradually expecting a shortening of the CCC. Not right now, but you think your cash conversion cycle is going to come down over time. Suitable if you can forecast your permanent current assets with a high degree of accuracy. That's what we're trying to match. Pros, it is flexible. You can increase your financing for your seasonal needs, and you have a diversified source, or rather sources of funding. You've got the short term and the long term. But apart from that, the pros and cons kind of just sit in the middle between your conservative and your aggressive approach. An example. What are the implications for an issuer of an increase in the line of credit offered to new customers? So we're going back to thinking here about cash conversion cycles again. Would there be a reduction in inventory levels? So the issuer is going to increase a line of credit offered to new customers. I don't see that reducing inventory levels. What should happen is that sales should go up. So if anything, we should need more inventory. So no. Faster collection reducing receivables? Well, no. We've increased the line of credit. If anything, that is going to increase the days of sales outstanding. They can take more credit. You're going to have higher accounts receivable. So no. Increased need for working capital? Yes, that's the one. Because my DSO is going to rise. Hopefully sales will increase leading to a need for more inventory, higher accounts receivable, increased need for working capital. Ability to pay creditors sooner, reducing accounts payable. No, they're just trying to trip you up there because it's got the word credit in there. This is to do with customers, not suppliers. Will there be no change? Well, no, we've already said there will be an increased need for working capital. And to finish off, let's just look at our sources of funding. We talked about in those approaches long-term versus short-term capital. Short-term funding, your financial flexibility is maximized if you develop and regularly review a short-term financing strategy. The objective, maintain sufficient diversified sources of credit to fund your ongoing needs. Don't be dependent on one source. Secure adequate funding capacity to handle changing cash needs. So you have the funding currently to meet your operations, but make sure you have the capacity. You may not have used it yet, but you have the capacity to meet changing cash needs. Make sure sources chosen have competitive terms. Know the cost, implicit and explicit. Understand how rates may change with market conditions. You're going to have to forecast where rates are going, we said. Your expectation of interest rates will dictate to a certain extent your approach to working capital management. Include, as I say, explicit and implicit funding costs in calculating your effective cost. We've seen the big example of that, supplier financing. Working out whether it's worth taking advantage of a discount or not. Factors that influence your approach, your size. The bigger the firm, the more access you'll probably have to credit. Sources of capital may have a minimum size. If you're a tiny firm, there might be some lines that are just unavailable to you. Creditworthiness, I think, is fairly self-explanatory. We'll look at a little bit of that in fixed income. Legal considerations. If you don't have well-developed markets, you're going to be a lot more reliant on trade credit. Regulatory considerations. We mentioned banks earlier. Banks have requirements for the amount of capital they have to keep. On the other hand, they have access to central bank funding. So it's very different to your normal retailer. And your underlying assets. If you have attractive underlying assets, you can use those as capital, as collateral to bring down your cost of borrowing. So let's finish off by looking at a little numerical example of short-term funding, just to put some numbers to it. We have accounts payable of 2 million, terms are 210 net 30, so a 2% discount for paying 20 days quicker. Some accounts receivable, some marketable securities, and we have a payroll liability of 200,000 Canadian dollars, which we need to meet. Which source should we use to pay it? Well, first of all, we could delay paying accounts payable. If we delay 200,000 of this, we forego a 2% discount. That's a cost of 4,000. We could sell accounts receivable at a 10% discount, it tells us. Now be careful with the calc here. We need to sell enough accounts receivable to leave us with 200,000. So we'd actually have to sell 200,000 divided by 0.9, 222,222, to leave us with 200,000. 10% discount on that. Cost is 22,222. That is significant. Or we're told we could sell marketable securities at a 0.5% brokerage cost, ignoring any tax on capital gains, etc. Well, 200,000 at 0.5% is 1,000. Which source should we use to pay it? Unsurprisingly, our marketable securities, those you can readily sell at minimal cost. Point of that example is just to say, as we mentioned on the last page, make sure when you're looking at your funding plan, you consider all of the costs, explicit and implicit. Another couple of questions. Down here, credit terms. If you change your credit terms from 110 net 30 to 115 net 30, so there's the change. You are giving your customers longer to pay and still get the discount. Impact on accounts receivable. They have longer to pay. It will go up, as will your days of sales outstanding. What about credit terms? You extend credit to customers with lower credit ratings. Extend credit to customers with lower credit ratings. They are going to take longer to pay. They're taking longer to pay. Once again, your days of sales outstanding are going up. Drag, pull, or no impact. Definitely has an impact. It's taking longer for cash to come in. It's a